Welcome back. Today we're looking at a very high energy analysis report, SMX stock forecast. Will the squeeze continue Monday? It covers that wild 250% surge in Security Matters PLC after their big tech news.
Yeah, that energy definitely comes through. But the real question is, how do we make that energy and excitement last beyond just, a Monday morning trade?
I agree completely. The whole analysis is very focused on the squeeze itself. So I think our first point has to be about anchoring all of this in some real foundational value.
The analysis needs to integrate the fundamental technological catalyst, the molecular firewall, more deeply with the short-term squeeze mechanics to provide a more robust and sustainable valuation forecast.
Okay, so right now the tech news is just treated as rocket fuel for the squeeze. What's the weakness with that approach?
The report treats the breakthrough merely as a trigger for, short-term retail excitement. It's not being used as a real justification for why the stock is in a new trading range. So by focusing so much on the squeeze mechanics, the whole thing risks looking like a tactical spike without any legs. If that momentum fades, and it always can after a move like that.
The analysis looks flimsy.
Exactly. Because the underlying value case wasn't built strongly enough to hold that new price level.
That makes a ton of sense. I mean, if we're calling for $65 or $70, that can't just be short covering panic. It has to mean the company's actually worth more now. So how do we reframe it?
We need to reframe the analysis to use the molecular firewall tech as the underlying support. It's what turns a temporary squeeze into a legitimate revaluation event.
I see.
That's what justifies targets like $65 or $70. It's not just panic. It's a fundamental shift supporting the technical move.
I wonder, though, if you spend too much time on the tech, do you lose the urgency? I mean, the audience is here for the Monday morning game plan.
That's a fair point. But we can be efficient. We're not writing a scientific paper here, but we need some ballast. For example, you could quantify the potential market size.
Okay.
Just mention the estimated, trillions in global counterfeiting losses that SMX is trying to solve. That one fact gives context to the jump. It anchors the whole thing.
So the news isn't just a trigger anymore. It's a foundational support beam.
Precisely. And you can link it directly to the short's problem. You could argue the new tech completely changes their risk assessment.
Right.
Now they have to cover not just because of the high fees, but because the company's future actually looks, a lot brighter. So instead of just calling it a bombshell, maybe dedicate one quick paragraph to the revenue path this opens up. That grounds everything in business reality.
That's a much stronger way to build a case for those high targets. Okay, let's pivot to risk. The report does a decent job here. It identifies profit-taking, volatility from the low float, and it notes the 1-for-8 reverse split.
The assessment of downside risk, particularly concerning the low float and the recent 1-for-8 reverse split, requires greater depth to fully account for potential structural headwinds.
They're mentioned as volatility drivers, but what's the critical risk that's just not there?
This is a major structural gap. The analysis mentions the split and the float only in terms of volatility. It completely fails to analyze the structural financial risk. We know reverse splits are often, precursors to capital raises, secondary offerings, at-the-market agreements.
I see exactly where you're going. The company is suddenly trading at a price they probably never dreamed of, and they have a massive incentive to cash in on that spike.
Precisely. This risk of sudden dilution is, I would argue, the single biggest threat to the bull case, and it's just completely absent from the risk section.
Yeah.
They just did a 1-for-8 split. The share count is tiny. Now the price is high. They can raise a ton of money by issuing way fewer shares than they could have a week ago. That's the real risk here.
And that is a critical issue. Any experienced trader is looking for that. We all focus on the short interest, but something like this is a totally independent source of selling pressure. How fast could a company even do an offering in a situation like this?
Very, very quickly, especially if they already have an S3 registration on the shelf with the SEC. We've seen this movie 100 times. A stock runs 300%, and 3 days later there's an offering that knocks it down 60%. That's the landmine.
So the suggestion is to dedicate a whole focus section to this possibility.
Absolutely. The report needs to explicitly talk about how the company might use this high price to raise capital and what that would mean for the stock. It shows the analysis is thinking about corporate strategy, not just chart patterns.
So how could the writer actually put that into practice?
Well, for one, suggest researching their recent SEC filings. Look for an S3. See if they have shares ready to go that could be sold Monday morning right above that $48 support level.
That's real due diligence.
And then you need to redefine the bear case. It shouldn't just be about momentum fading below 48. The real bear case is the announcement of a capital raise that creates a flood of new shares.
That elevates the bear case from just a technical pullback to a huge financial threat. It's a necessary warning. The analysis has to warn traders this could happen right at the open.
It would completely change the dynamic. It stops being a short squeeze story and starts being a capital restructuring story.
That is some exceptionally robust advice. Okay, let's move to our third area, the tone. The piece has this energetic, urgent, must-watch feel, using phrases like rocket squeeze and supernova.
And I get why. You want to capture the excitement of a momentum trade. But that reliance on highly urgent and sensational language, while it's great for getting clicks, it kind of reduces the perceived objectivity of the forecast.
I can see that. So the heavy use of hyperbole, calling the move the craziest or the news a bombshell, it signals that this is more about chasing momentum than calculated risk.
And that tone weakens the credibility of your price targets. When you say $65 or $70, the reader might start to feel like they're reading a promotion, not an objective analysis. And that's a dangerous line to cross.
Hold on, though. If the target audience is retail traders who are in it for the squeeze, don't you risk losing them if you switch to, precise technical terminology? Are we sacrificing engagement for rigor?
That's the balance, right? And I think you can do both. The suggestion is to keep the high energy, but shift the language from just emotional descriptions to precise technical terms.
Okay.
You ground the volatility in a professional context. It makes the forecast feel actionable, but also serious. You're shifting from entertainment to real expertise.
I like that calibration. You're using the technical vocabulary to justify the excitement.
For instance, instead of calling it a game plan, frame that $55 level as a critical technical inflection point. You could refer to it as a high-volume node or previous resistance. That explains why 55 matters from a market structure perspective.
And what about replacing the emotional words?
Oh, absolutely. Instead of exploding again, use something like confirmed continuation pattern or, and I like this one here, imminent gamma squeeze potential.
Ooh, yeah.
That last one still sounds explosive, but it signals you understand institutional positioning in options markets. That instantly boosts your credibility.
I see. It shows you're looking at more than just the retail side of things.
Right. And one last thing on this. When you talk about the illegal trading tactics, balance that urgency with a quick, neutral reminder that regulatory issues are complex and often play out over a long time. Don't frame it as a guaranteed call to arms for Monday morning. It just adds a bit of journalistic balance.
That's all really actionable. It honors the writer's intent, but seriously boosts the analytical rigor of the whole piece.
The core of the analysis is strong. The catalysts are there. But to really elevate it, we have to make sure those bullish targets are built on more than just momentum.
Absolutely. So to summarize the opportunities for the writer, first, integrate the fundamental value of that molecular firewall tech. Make it the foundation for a real revaluation, not just the spark for a squeeze.
Second, you have to deepen the risk assessment around that reverse split. That means stress testing the capital structure against the immediate threat of dilution from a secondary offering. That is the key downside risk here.
And finally, calibrate the tone. Shift from sensational hype to precise technical language. You can still keep the energy, but you'll boost the analytical credibility of the entire forecast.
The goal here is to strengthen the report by grounding those high-flying targets in real value, and by being honest and rigorous about the very real structural risks. You do those three things, and this goes from a great trading call to a truly comprehensive investment analysis.